What if I told you that backdating a permanent life insurance policy by just a few months could potentially save you thousands in long term insurance costs, but could actually leave you with less cash value in the short term if you're not careful? In today's episode, we're going to break down a real client scenario where different strategies were tested. We looked at regular dating a policy, a 6 month backdate, and even a full 364 backdate. The results were surprisingly close, but not for the reasons you might think. If you've ever wondered whether saving your age is more important than max funding early, this is the episode for you. Now, if you're wondering what the heck is a backdate anyway, don't worry, we're going to summarize that as well. This is a Canadian Wealth Secrets episode where we are going to take the inspiration from a client scenario. It's actually spouses Imran and Sonia, and we're going to tackle the nuanced but important question: when is saving your age the right way to go, and when is it worth just letting it go? All right, my friends, here we go. First and foremost, let's chat a little bit about backdating. As you may or may not know, when we talk about high early cash value life insurance strategies on the podcast, you'll know that as the resident math geeks here, we love to analyze and we understand how policies can be designed to really help serve different reasons. Okay. Our audience typically likes to preserve high cash value early. However, there are situations where a high death benefit is really the right goal or the right need for a specific client or a specific situation. So understanding the knobs that you need to pull in order to help clients achieve the best goal for their potential outcome or the actual goal that they have for their wealth building journey, estate planning, or investment needs can vary from person to person. Now, in this particular case, we're talking about a young couple. They're in their middle ages, and they were talking about max funding a new policy. It's going to be corporate owned, so they get all the benefits of the capital dividend account and the net death benefit, being able to pay out tax free, and lots of benefits there. But when it came down to actually putting this policy in force, they were grappling with the idea of whether it's worth saving age or whether it's worth actually putting more money into the policy now. As you can imagine, there's some nuance here that's really important to note. The younger we are with insurance, the cheaper the insurance itself is. Now, keep in mind, when we run illustrations for high early cash value policies, or maybe those policies that are really seeking high death benefit initially and not really concerned about cash value, we can look at an entire illustration, and that illustration is based on the current dividend scale that the insurer is paying out of their participating fund, which is really helpful for us to really get a sense of what may or may not happen over the life of the policy based on different funding schedules. So when it comes to high early cash value, it's all about trying to fund the policy to the max in the early years. Well, the real question though is, like, what matters more, early funding or backdating these policies? When we backdate a policy, what we're doing is we're saving age. Many insurers allow you to backdate the policy up to 6 months. Why 6 months is really important is because insurance companies will round your age to your closest birthday. So if you're born in January, let's say, and you are putting the policy in force when it's March, they're going to round backwards to your last birthday. However, if it's your birthday's in January and you are putting a policy in force in, say, November, they're going to round up to the next birthday. And that can obviously have an impact, because if I'm always a year older on paper, they are essentially going to be calculating the cost of insurance in the background behind the illustration with essentially a higher risk, because you are now 1 year closer to the average age or life expectancy of female, male, with smoker, non-smoker, and all the other details that they put into this formula. So saving age is always a great idea when we can, but there's nuance here that's really important. So if I could just save my age and say, can I be a year younger? I would take it. But the problem is when we backdate by 6 months, or with some companies, all the way back to 364 days, so almost a full year, what that does is it actually fast forwards your policy in time. And basically what it says is it's like, if I go back 6 months, basically I'm putting a policy in force today. Let's pretend it's June 15th. I put that policy in force today. What they're saying is you actually put the policy in force 6 months ago in order to save age. And that also means that the whole first year premium is due. Plus, in 6 months from now, you'll be paying year two's premium. So that means you're going to be paying 2 full years in 18 months instead of 24 months. This can have an impact on how much you may or can put into the policy, which may hinder your ability to reach max funding. So let's look at the full 364-day back date. Why someone might consider doing this is someone who actually wants to get 2 full years of premium in up front, and then they just want to pay every year after that. With the 6 month, you're kind of putting it offset. You're offsetting your premium date by 6 months. So you're going to pay the whole first year now, but then you're going to pay your whole second year, or I should say your whole second year, not your whole second year, in 6 months from that date. So this is really important when we're trying to think of our funding schedule, because if our goal is high early cash value, we want to try to be max funding our policy in the early years. If I backdate a policy a whole year or 364 days, and I have to pay 2 full years of premium now, but I only have 1 full premium, it is likely that I'm actually going to min fund or minimum fund the first year and potentially only minimum slightly higher than minimum fund the second year to get this policy going. So it's really important when we're starting to think about how we structure our policy that sometimes the actual savings in the background for backdating actually isn't worth giving up your ability to max fund the policy. Up on the screen for those with YouTube or watching on YouTube, you will see a policy. We're looking at a $20,000 per year max funded policy here. And we're calling this the regular dated policy. This is a 39-year-old individual, and we're going to say their birthday was June 1985. That's what this policy is running for. And what you're going to notice is there's a minimum premium they can contribute, which is about $7,500. The cash premium, the maximum premium they can contribute is $20,000. And you'll notice that over time, that cash value is going to continue to grow, as we typically see with high early cash value policies. You're going to hit the break-even point somewhere around year 4 or 5. That's usually also the early offset point given current dividend scales for most companies, including this one that we're looking at here. You'll also notice the death benefit that we're accumulating over time. If you have a company, the capital dividend account credits listed there, as well as the adjusted cost basis. So we're putting $20,000 into this policy. If we backdate the policy by 6 months, what that does, and I'm going to just go to the next tab here, you'll notice that while their actual age is 39, you'll notice that forgive me, in the first scenario, their actual age is 40. And when we backdate by 6 months, you'll notice that their age is actually now 39, meaning the end of year 1, it's going to record them as only being 40 years old, as you'll see in the table. Couple things happen. First off, the minimum premium goes down a little bit. Why? Because the cost of insurance is slightly lower. Now, this person being only around 40 years old, actually 40 years old and backdated to 39, is actually not going to see a huge amount of savings because they're not that old. However, this gets more and more dramatic when we put policies in when we are older. So if we're in our 50s or even early 60s, you'll notice that backdating will actually have a much more significant impact, and that might influence your decision as to whether you should backdate, even if it means not max funding in the first year. However, here for this particular example, you'll notice that the cash value is going down slightly for this individual because we backdated by 6 months. But the death benefit has actually increased a little bit as well. So because they are actually a younger individual on paper, they're actually going to get more death benefit. So in the first case, in the regular dating case, they're going to have about $17,200 of cash value by the end of year one if they max fund $20,000. And they're going to have a death benefit of about $423,000. If we do a 6-month backdate, what we're going to have is $16,988 of cash value, about $300 off in cash value initially. However, the death benefit's going to start actually a little bit higher here. We have $436,000 of death benefit. So there's a little bit of give and take here. And basically why this happens and why this works this way is because the person who's backdated their birthday, first of all, the costs are a little cheaper. So the insurance is cheaper for them to buy, which is great. But they also have a longer runway until their expected age of life, or when they plan to, or not to plan, but when stats suggest that this male non-smoker may actually pass. And therefore, the cash value starts slightly lower. However, the death benefit starts slightly higher. And if we were to fund this over 10 full years, $20,000 for 10 full years, and then stop funding this policy, and then we actually go out, you'll see after 10 years, when we do a regular date, we've got a cash value of about $245,000 and a death benefit of about $867,000. So quite substantial, a nice little opportunity fund that we've crafted here. We like to call it the wealth reservoir for many people. When we look at the backdated policy, the cash value is at $245,000 as well. So at about the same cash value. However, the death benefit's at $894,000. So that death benefit is still higher still. And if we continue to scale out, you'll notice that by, let's look at age 70, they've no longer contributed after 10 years. So age 70, what you're going to notice is that we have a scenario, or actually I should say after 30 years in both cases, okay? One's going to suggest that they're a year younger. After 30 years in the regular dated scenario, you're going to have about $1,000 of cash value. The backdated policy is going to have about 628,000. So now the cash value is starting to sort of, separate itself from how equivalent it was in the early years. So we're starting to see a little bit better cash value growth in the later years. Nothing crazy, like nothing to write home about here, but it is happening. However, on the death benefit side, you'll see about 1,064,000 of death benefit in the regular dated policy, whereas in the backdated policy, we have 1,095,000. So we are still seeing like about a $30,000 difference in death benefit. And over time, that cash value is going to slowly take off on the other policy, and the death benefit's going to continue to be higher over time. Now, this would be more dramatic if we continued funding these policies for longer than 10 years as well, right? The longer we fund them, the more dramatic the differences will become. However, if we chose to minimum fund that first year on the backdated policy, we'd actually be hindering that policy, and we'd actually see less benefit. We would see some initial death benefit. It may be comparative, but the cash value would suffer and the future growth of that policy would suffer. So in this case, what I would argue is that in many cases, if we're not intending to maximum fund the first couple of years of our policy, the backdate is actually not going to work to our advantage. It could actually work to our disadvantage. Now, if we do minimum fund in the early years and we intend to max fund for many years, then of course, over time, it can overtake the other policies. So what you're seeing here is there's no easy answer to this. Some people are going to say, well, what about the 360 backdated policy? Well, really, the only difference, the illustration is going to look identical to the 6-month backdated policy because they're the same age individual. However, you're getting more premium in faster. So where you see the difference on these backdated policies is that you're actually getting the opportunity to fund more into the policy faster, and you're getting some cost savings on the insurance side. So by putting those two together, you get a great outcome. If you do one without the other, you're sort of like offsetting the value of the backdate. So with each and every client that we work with, we are always trying to get to what is your goal and what is your funding schedule look like. Those people who really like the backdating by almost a full year, by 364 days, are the individuals who have a large sum of money and they're looking to start their policy off and essentially fast forward to the next year in the policy. They're able to fund the full year one and the full year two all up front, and then a year from now continue funding the maximum. That is typically where we see a backdate being most valuable. If we're going to backdate but not maximum fund because I have to pay more premiums sooner, then in my opinion, that's probably not a very well designed policy, right? I would rather see the policy maximum amount go down for the life of the policy if you want to max fund 2 years all up front. But note that now you're limited in how much you can fund in future years. If I'm going to bring down the maximum premium, that's going to have an impact on how much you can fund in future years. So each and every scenario is really important here. However, it's worth considering your scenario and thinking about the fact that there is no right or wrong answer for any individual other than something that is crafted specifically for your scenario. There are no easy blanket statements here. So what I'm going to recommend for you is that if you're thinking about creating a policy in order to preserve wealth, in order to utilize as a corporate or personal wealth reservoir or an emergency fund, definitely consider reaching out to us over at CanadianWealthSecrets.com/discovery. And you can hop on a call so we can discuss your particular scenario and run you different situations. If you know exactly what you'd like to fund over X number of years and how and when you want to do that funding, we can help you to run those scenarios and compare them to other situations and other policy structures to make sure that you're getting what it is that you are after. Also, if you're curious where you are in your own wealth building journey, we encourage you to reach out and head over to the CanadianWealthSecrets.com/pathways page where you can take our wealth assessment. What it will do is actually unpack the 4 stages of our wealth planning system, and it will give you how well you're doing in each category, as well as a full report to help you figure out what you should focus on next. Once again, that's over at CanadianWealthSecrets.com/pathways. We so appreciate you, all the ratings, the reviews, and the referrals that we are getting from our wonderful, wonderful Canadian Wealth Secret Seeker audience. Keep up the great work, and we look forward to working with you soon. Just as a reminder, this content is not advice. It is not investment, accounting, legal, tax, or financial advice. Please reach out to your advisors for any advice that you would like to put into place. If you'd like to reach out to us, note that I, Kyle Pierce, am a life licensed and accident and sickness insurance agent and the president of Canadian Wealth Secrets Incorporated, and I would be more than happy to help you plan your holistic wealth management plan. Chat soon.